Hello and welcome to this exclusive interview with Rajan, the Governor of the Reserve Bank of India. Mr. Rajan, thank you so much for joining us today. Clearly interesting times for the economy and more so from what you've done in the latest monetary policy. A decisive shift, as some are calling it, especially on the liquidity front, reversing something that's been the norm for almost 5 to 6 years. Is this the way really now that monetary policy action can be expected in terms of what you outlined as a progressive shift from a deficit for liquidity to a neutral stance? Are rate cuts, a repo rate cut, not something that we can expect at least in the current year?
No, I don't think you should see it as that. I think you should see this as a continuous path of reform, where we've moved from what was a monetary policy system which had certain peculiarities relevant to the Indian situation, to something where we have a monetary policy framework which is more attuned to the open economy that we have become and is much more consistent with the system elsewhere in the world. So it's been a series of steps. Of course, our blueprint has been the Urjit Patel Committee report. But just to give you a sense of how this is just an extension of that process, of course, a lot of steps were taken yesterday, so it seems like a dramatic shift. And to some extent, the shift in philosophy is significant, but it's part of a continuous process. The Urjit Patel Committee report suggested we move away from facilities to lend to market-based auctions. And we have been doing that steadily: overnight repo auctions, overnight reverse repo auctions, term repo auctions, etc. Now, what that does is allows us to set the rate in the market close to the policy rate, and if it's not close to the policy rate, we provide more liquidity or take out liquidity to get it close. Given that, it's not the rate at which they borrow from the windows or they deposit at the windows which is important. Now, when it was the rate at which they had to borrow from the windows, we had to make sure they went to the window, which meant we had to run the system in large deficit if the rate that we wanted was the repo rate. Given that that's no longer the way the policy rate is set, we don't need them to come there. So we can move away from deficit, which was the suggestion of the Mohanty Committee, to a more neutral rate and a neutral stance of deficit. Now, the time period over which we do this, we have to make sure it doesn't create disruptions in the market and is at a measured pace. That is what we intend.
Could it be inflationary in nature, because you will see more money coming into the market?
And some people are calling it a sort of quantitative easing by stealth.
Well, so that's an interesting expression, and I think the answer is no. First, what we're doing is replacing one form of liquidity with another form of liquidity. So we're providing more durable liquidity, but that means that we provide less temporary liquidity. So in that sense, there's not more money creation in the economy. Quantitative easing is about creating excess reserves and forcing it on the banks. We're not creating excess reserves in any way. What we're doing is really accommodating the demand for reserves. And that's really the difference between this and quantitative easing.
In very simple terms, what is it that is sought to be achieved from a very broad macro fundamental point of view? Because this is a capital constraint scenario. There is illiquidity, but perhaps not because of the central bank's policies, but the way balance sheets of companies are impaired right now. What does it in very simple terms hope to achieve over the next couple of years?
So I think the single biggest change that has happened is the move to the marginal cost pricing. That will, to some extent, put pressure on the banks as their marginal cost falls to pass it through to lending rates. And I think what's important to note is even before the policy cut yesterday, median marginal costs had come down by 25 basis points overall tenures, and overnight had come down by 50 basis points. I think that's a big shift. And I think because they'll reprice every month, you'll see this rate cut feed in going forward.
I just want to ask you a question before we finish that, is the fact that then do you think all the conditions have been met for transmission? Does anything else need to be done? Because small savings rate has come down, you as well have now moved on the liquidity front.
Well, everything is moving, so it's moving in the right direction. So I think more transmission will take place. Now, Transmission also takes place as a result of competition. Competition between the banks and between each other, and between banks and money markets. So money markets now, there's a fair amount of liquidity, especially as the new fiscal year sort of comes in. And so my sense is rates will drop. We've already seen overnight rates, commercial paper rates, some fall yesterday. So my sense is this is a process. Some people ask me, do you worry about the market reaction? The market was reacting to global factors and local factors. There was some anticipation. There was some stuff that was priced in. I actually don't worry too much about immediate market reactions. The broad point is get the economy going over the next quarters. And I think conditions are in place for that to happen. The transmission will take place. And more transmission may take place as more credit pickup happens, as banks feel more comfortable that there is profitability both in terms of volumes and as well as margins.
What more would need to be done? Because there are some downside risks yourself that have been identified. Has that optimal sort of monetary stimulus setting been achieved? Because some moves have been made on the small savings rate also.
Look, we are still one of the higher inflation rates in the world. There are many countries that are in deflation, and that's what's reflected in our WPI. But CPI is still 5.5, and there are some elements which are stubborn. So, to the extent that our inflation goes closer to the world inflation rate, room will obviously build up for more policy rate cuts. It depends on a variety of circumstances, including the fact that the capacity constraint that is important today in our economy is not so much the manufacturing capacity constraint, whereas many manufacturers tell us there's excess capacity. It's really the services capacity constraint as well as food. But services, education, healthcare, you're not seeing the inflation rate there fall dramatically. So my hope is that as these inflationary expectations, lower inflationary expectations build in, some of those price increases will also abate. There will be some supply coming in. Let's see. I mean, it's something that we have to wait and watch. The point I'm trying to make is our level is much higher than the world, so I would not rule out the possibility that more room would build up over time.
So let me push that conversation a bit forward, Dr. Rajan. In this particular policy, even the most conservative economists were placing a 20 to 30% probability of a 50 basis point rate cut for you. Did you have that room and chose not to front load it and say let's wait for monsoon? Because you have set some further preconditions for a further rate cut as well. Did you have that room already and you're just giving it more time?
I think we've always used whatever room we had. We're not holding back rate cuts for some masochistic reason. We do what we can because we are aware that the economy is still somewhat below capacity. The point, however, is that at this point we thought that first, room was very limited given the uncertainties. We'd like to see the uncertainties play out. And we've always sort of tried to wait till we have enough information before moving. People may call it conservative, but I would say, given our past history, given the fact that we're building credibility and that we have sort of delivered so far, it would be a mistake to throw it all away on a wild sort of aggressive move. That's one. Two, I'm not sure the aggressive moves pay off if there is no transmission. So what you should see in yesterday's policy is the aggression is on the transmission. That we are trying to make that transmission happen. Don't call us conservative. The moves yesterday were in some ways pretty bold given what given the past frameworks. But we think they're reasonable given where we are. We don't think there are big risks in the move. But what it will do is put pressure on the transmission. What you don't want is an overhang of rate cuts that have not been transmitted, and then one day you sort of make the transmission happen for some, if you take some actions, and suddenly there's a huge amount of gush. It's like a dam. You don't want dams building up pressure elsewhere, and then the economy gets flooded. So we have to. I think the key bottleneck was transmission. We worked hard on that. And I would see this as much more than a 25 basis point rate cut. And this is something both our industrialists who are complaining as well as the market will over time see, that the effects that of this will be larger.
In magnitude terms, perhaps, you didn't get to meet bankers yesterday, at least that's my understanding. But have you sort of heard from banks, or is there likelihood of you hearing from banks in terms of the transmission and what they intend to do about it?
Well, I think you guys interviewed the bankers yesterday. They were all in Delhi, and my sense is they will say they will transmit as things happen. But I think all, to your question earlier, all the conditions are in place, and there is no
both on the fiscal and monetary side.
Exactly, there is no further impediment. And we should see this happening. Of course, we will keep our eyes open to see if there are still any bottlenecks, but I don't think there are.
If I could disagree there for a moment to say if there are no impediments, I would say that the bank balance sheets are the biggest impediment at this point, because margins are getting
There's no impediments that monetary policy can do something about, monetary policy and liquidity management. Risk aversion, capabilities, those are things that we have, I think, less control over because we regulate but don't own the banks. I think if you look at credit growth, and this is something that I have emphasized elsewhere, one of our worries was that the public sector banks were falling behind in credit growth. Yeah. I don't think that's a bad situation. If they're trying to repair their balance sheets, it's appropriate that they repair it while keeping growth constrained, while figuring out what went wrong and finding out ways to do good credit growth rather than bad credit growth. I don't think the answer that in the past some banks have found of growing the balance sheet so that bad loans become small in ratio, that only postpones the problem to the future when all the new loans you've made turn bad eventually. But I think if you look at public sector credit growth, 6.6% the last time I looked at it, private sector credit growth 20%. That difference is precisely your point about balance sheet. That's not about liquidity, that's not about monetary policy. It needn't even hamper transmission. You can still give any new loans you make the lower rate, and you may be forced to do that because the private sector banks and the markets are competing with you.
I wanted to come in, and I'm actually skipping a question because this is completely related to the point that you make. This is to do with the fear psychosis that we observe as reporters in the field, in the banking system. And we are talking just on the same day as a very senior government official has spoken about the C's that are hampering decision making in government. He was referring to the CAG, the CVC. The joke is also, Dr. Rajan, if you permit me to say that, the signboard outside bank says, only Aam Aadmi borrowers welcome. The point that a lot of people are saying, you want a loan for a fridge, for a washing machine, for a television, most welcome. But when it comes to industry, when it comes to that larger job creating part of our economy, things are simply not moving, and banks are not taking decisions due to a fear psychosis. Is that assessment correct?
I don't think fully, because I do think that so far the investment demand from the private sector hasn't picked up strongly. When that does pick up, we'll be able to test your proposition, whether in fact credit growth is being hampered because people aren't willing to lend. And of course, hopefully, some of the slack in the public sector as it's trying to figure out its balance sheets is being picked up by the private sector. I would say this, that the investigative agencies and the, the C's that you call them, I mean, one shouldn't completely sort of rule out their point also. Yeah.
They're a part of the ecosystem.
That there have been loans that have been made without appropriate diligence, where you question the circumstances in which they were made. What an appropriate view would be is to put yourselves in the shoes of the banker at that time and ask, under those circumstances, was this a reasonable loan to make? And did you take adequate precautions? Did you do appropriate due diligence? Did you take the collateral? Did you perfect the collateral? You know, were you taking proper care of public money? And I think in some cases the answer would be yes, in some cases the answer would be no. And their point is, if we don't see appropriate action based on things at that time, we have to take action. That's perfectly valid. However, it is wrong, in my view, to look at it with 20/20 hindsight. Now we know that this industry went bad, or the loan was valued for the firm as a going concern, but the firm turned out to not be a going concern. Therefore, all these assets went bad. Well, those are suggestions made with a lot of hindsight. And what I want to emphasize is that there's always, when industries are going through bad times, on the bankers, on the regulators, on everybody, on the government, a whole lot of suggestions that this is a temporary downturn. Please help hold hands for the industry. It will only take, it's a matter of time before it strengthens, and there are so many jobs at stake. I can roll off some names of industries today: steel, sugar, these are all real estate. These are all industries that you get application after application from the industry, from banks, from others. Please help them, forbearance, this, that. Now, that same thing happened in the past. So to the extent that forbearance was based on some of these views, but the industry didn't turn around, or certain elements in the industry went bust, I think it's unfair to apply a 20/20 hindsight to that situation.
One quick follow-up before we turn back to this matter, and this is again related. The SDR mechanism was supposed to sort of, get rid of bad managements, bring in sort of a new style of doing it. The banks don't have the capability to run the operation. Some of the sectors that you mentioned, existing promoters, therefore, by default, continue to run those operations. That was certainly not the design of the SDR as we understand it. But the bottom line is that write-offs, whether big or small, are needed so as to restructure business. And that happens all over the world. But again, the C's, the fear of the C's is coming in the way. Banks are not taking decisions. There are promoters who want to get out of it. For instance, in infrastructure, there are certain projects that we have reported about, but things are not moving. If these deals do not happen, how will you solve this problem?
No, I think this is where one has to, again, exercise care and caution, right? So there are certainly some situations where the debt that was taken on is now unrepayable. And in fact, if it sits on the books, will chill incentives for everybody, the promoter, the other suppliers, and so on. So even in developed countries, there is a write-down. The problem, of course, is what are legitimate write-downs, where in fact you need to do it, and in fact writing down you'll get more money back, because at least the debt that you've written it down to will get paid back. What are legitimate write-downs, and what are write-downs which are underhand, where you've done a deal with the promoter and there's some payoffs and so on. What we need is a reliable process by which the banks can do these deals, and it is not second guessed and third guessed and fourth guessed all over. So the JLF process is a way to get the bankers together. Now we've put a high-level ED's committee to sort of vet some of these decisions. My hope is that some of these decisions will actually happen, and because there's a committee, there are multiple people, there's less of a sense that this is a sweet deal. The truth is, this has to be done in an atmosphere without trust, it cannot happen.
Yeah.
It cannot happen. And it is also important that every Tom, Dick and Harry in the system doesn't start raising his hand and say, I object. I have an opinion on this. Because if that happens, I mean, look, everybody has an opinion on monetary policy, what the interest rate should be. Now everybody will have an opinion on what the appropriate amount of write-off. I mean, you have to trust the experts, but for that we have to create a structure of trust. But I think it's important that once that system is created, we allow it to work, and we don't have somebody or the other sort of interfering in that process all the time. Watchdogs are important. Where there is evidence that things have gone wrong, by all means we need to investigate. But let us not go on fishing expeditions.
So, Dr. Rajan, before we move on to the global scenario, as we wind down this conversation as well, I want to get a sense on what's next on the asset quality review. The AQR has now got a great short form because it'll be recognized. It'll be the quarter where most of the banks will sort of take it on the books and feel the hit. What's next? You've got a 1 year of full cleanup. What's next on the agenda?
So, the AQR, which was really a coordinated financial inspection across a number of large banks, basically identified, without getting into the technical details, two broad sets of assets. One where action was probably needed quickly, and that the banks were given till March 31st to figure it out. Of course, the stuff where it was absolutely clear they were supposed to do it in the first quarter, that is December. Stuff where there's some hope for putting the asset back on track, they were given till March 31st, and they have some assets coming back on track, but whatever needs to be done will be done. That was for the first lot of assets. Then there are assets which are weak but not yet clearly identified in one box or the other. That they have a somewhat longer time to deal with, to put in whatever performing or non-performing. So that is really what they have to do over the next year, and they, because they're not yet sort of in the emergency room, there's time to deal with them and to put them back on track. My hope is, therefore, by March 31st, 2017, we'll basically have dealt with the problem.
Okay. On the global scenario, there was, till recently we had a situation where there were question marks about flows to emerging markets. Has that abated, has that receded, essentially given what the US Fed now seems to have taken as a stance? Is there going to be more or less stability on that front in the next few quarters?
Until the next big event. I don't think there's, look, I'm firmly of the view that we are not in a stable world, that all we're doing is buying time through more accommodative policies across the world, but until we see real sustainable growth, asset markets will still be extremely jittery. And the hope is that we all do the right thing. But as you saw over the last year, there are events across the world which can panic markets. I don't think that there is an obvious source of concern. It just seems to me that the kind of policies we've had for the last 6 or 7 years have created an environment where there are, always people are looking at each other and saying, when's the next guy going to run?
So what will it finally take to revive?
Strong growth. I think once we have strong growth, that stronger growth, that will be the indication you can feel more comfortable. Either that, or we bring policies back to ground. Policies aren't going to come back to ground until we have stronger growth. So it's sort of, we're stuck in this loop.
You co-authored a paper all the rules of the monetary game with Prachi Mishra, recently a first for the RBI as well. What's the real cost of the negative rates? What is the changing norms now? We've seen pressures on exports, remittances, service exports. They've been the two pillars of balance of payment up till this point. What kind of ramifications, what kind of concerns do you have right now?
Well, worry about accommodative policies, overly accommodative policies around the world, is they elevate asset prices.
Yeah.
And they keep exchange rates at values that might be different from equilibrium values. What happens if you've elevated asset prices is real growth and fundamentals have to go up to match that higher level. That's why I said the one thing that will save us is very strong growth, because if we get strong growth, then the asset prices are verified by the strong growth. Most asset prices, perhaps not bond prices, but certainly equity prices will be verified. The problem is that we have to keep monetary policy so accommodative till that actually happens. Now, if that's not happening, growth is still, you heard the IMF managing director yesterday say things are still bleak and the new mediocre and so on, then this is not QE 2, 3, 4, it's QE infinity. We keep doing it because it's not going to meet, right? That is the concern, because every once in a while asset prices then start going back towards fundamentals, which is far lower than the elevated level at which they have been kept. And that's the risk-off phenomenon. And then some central bank says, no, wait, more accommodation. And we go back to the higher level until, so the point is, I don't think this is a stable situation that, either we need stronger growth or we need to recognize we've reached the limits of monetary policy, and slowly, I don't say abruptly, slowly we get back to normalcy across the world. Now, if every time a central bank starts moving towards normalcy, it says, no, exchange rate appreciating, turmoil, etc., we got to go back. We're in it for a long time.
Okay, my final question to you really, and drawing from your last statement, there's a lot of market participants, and I hope you appreciate where this question is coming from, is about continuity at the RBI and your continuity here. Mm-hmm. What can you say at this stage?
Nothing. No, it's, I have a term which ends at some point.
And you're keen on continuing?
No, we'll see what happens. It's a hypothetical question. I can't answer it.
Well, there are a lot of people who would want that question to be answered right now, but Dr. Rajan, thank you so much and all the very best for the future. Thank you for joining us.
Thank you.